We've all heard about the coronavirus and how to protect yourselves from it health-wise, but what about protecting your wallet? What about protecting your money? Chris Hopkins is here from Barnett and Company to tell us a few things that we probably should know, but most of us don't, about the coronavirus. Chris, good to see you,
Chip,
my friend.
good morning. Thank you.
This has been obviously a huge impact on financial markets worldwide. Global growth is projected to be, what, 2.5% below what it is? A lot of huge companies are withdrawing their profit forecasts. This has got an incredible domino and ripple effect area-wide. And I want to start by the Federal Reserve cut interest rates by 0.5 point earlier this week in an emergency meeting. How does that translate into folks like you and me?
Right. Well, for you and me on our everyday lives, it really has very little impact. I mean, the fact that interest rates went down is good if you're borrowing money. You're going to refinance your house, for example. This is a perfect time to do it. You know, we're going to see mortgage rates in the next month at probably close to historic lows. So, you know, think about, if you can, refinance into a shorter term, like a 15-year mortgage. You'll probably be able to get rates of, you know, eventually maybe less than 3%, 2.75% on a 15% loan. So that'd be one area where it does impact us. Now, in our daily lives, in terms of, you know, what's going on with our portfolios, our 401ks, you know, because we're all watching the screen every night when we see these huge swings. For long-term investors, we're investing for retirement. We're throwing money in systematically in our 401ks. That these things come and go, but we shouldn't dwell on them. So what happens is it gives us an opportunity, really, to put money to work.
So this is actually an opportunity for the average ordinary investor to actually make money as opposed to losing money.
Right. I mean, there's an old adage, buy low,
sell
high. Well, so we're not as low as we were a week ago, but the fact of the matter is that systematically investing takes the guesswork out. If I could ask you, you could ask me, I couldn't begin to tell you what's the stock market going to do on Monday. I have no idea.
Sure.
What's it going to do over next week? I have no idea, but I have a pretty good idea over the next 10 years what direction it's likely to go. And so you play those odds. So what we do is we invest systematically and regularly and routinely, and then we go back periodically, let's say twice a year, and we rebalance everything. So you start with a plan. You have an idea. I've got so much in U.S. equities. I have so much in bonds. I've got a general game plan. But what's happened over this last couple of weeks is stock prices have fallen, bond prices have risen. So if I look at my portfolio now, I'm a little heavy on bonds and I'm light on stocks. What I should be doing is reversing that. Take some of this off, put it back in balance.
And long term, of course, investors should never panic. So we're going to talk about how to avoid panic, and tell us, if you had to do 3 key points about why investors should not panic, what would they be?
Well, first of all, over the long term, you won't remember this. This has happened before. It happens regularly. So we get these 10, 15% corrections on average about every 2 years. It happens over and over again. So 2 years from now, we won't really remember that this even happened. It will have escaped our memory because we'll be on to something else. So you have a long-term focus. You don't obsess over these short-term things. So you just take those opportunities to, as I said, rebalance your portfolio, have some confidence knowing that this too will pass. We will get through this eventually. Now, as you mentioned, the Federal Reserve had stepped in. They're a little more aggressive than maybe they would have been 10 or 15 years ago. In fact, we saw a nice response in the market the day they did that. So the other thing I would suggest to you is, you know, you take this opportunity to do some of the other things. I mean, just paying off household debt. When you get these little panics, it's a good time to kind of think about your household budget.
And we were only, actually, we were overdue for a market correction anyway. Correct? All right, so if this does enter the bear market territory, how do we weather the storm?
Well, there's a good possibility that will happen. We don't know for sure, but we do know that economic growth in the U.S. is going to slow. It's probably, I mean, there's a chance at least that the second quarter may be slightly negative, what you would call a technical correction. Nothing that affects our daily lives, but the fact that the global economy has slowed so much, and that'll have an impact on us. So and there's a good possibility that'll happen. So how is our advice any different if we hit a bear market, say down 20% versus down 10%? And the answer is really no difference. Does it really change anything fundamentally my retirement savings plan over the next 10 years, I just continue to do what I'm doing. And I take advantage of those opportunities. If I have, so let's say I've got some money laying around, I've been a little worried that the market was overvalued, I didn't really want to go in at that level. Now you have an opportunity to go in at a better price.
So this is a good time to continue investing. You're in it for the long term. And if you're going to need this money short term, it shouldn't be in the stock
Shouldn't be
market
there
anyway.
And if it was, it's too late now.
Yeah.
So stick it out.
Hang in there. Hang in there.
Hang in
Chris,
there.
thank you
Good
so
to see
much.
you.
Good to see you, my friend.
Absolutely.
We'll see you over the coming weeks. We will see you on the other side of this quick break. In the meantime, you can get in touch with Chris and the great staff at Barnett and Company. Check out their website, barnettandcompany.com, barnettandcompany.com.